which is how do you get your money out of TIAA-CREF after you retire? All right, that will be a cornerstone of today's talk. So, accumulating money. Let's for the moment forget about the university match. And by the way, for the CMU folks that are here, if you work for University of Pittsburgh and you put in 8%, the university puts in 12%. So you get 150% return on your investment on day one. All right, where at CMU, they basically put in 8% and you can put in whatever you want. But at the University of Pittsburgh, you'd have to be crazy not to put in 8%. Because if you put in 8%, they put in 12%. So for the cost of 8%, you get a tax deduction and you get in effect 20% of your pay. All right, but so let's even assume that you're doing that. And if you're at Pitt right now and you're not doing that, you should just sign up tomorrow. And there isn't one excuse in the world that you could give me that would satisfy me that that isn't the right thing to do. All right, and people have tried. But let's assume for discussion's sake that you're already doing that, or you're at CMU and they put in the 8. Now the question is should you put more money on top of that? And what I'm going to do is I'm going to compare two people. They each earn the exact same amount of money. They have identical investments. They have identical taxes, everything else. But one says, hey, I'm going to put some money in my retirement plan over and above what I am required to, or over and above the match. The other person says, no, I'm going to save money the old-fashioned way. I'm going to earn the money, pay the tax, have the money be taxable every year. Compared to the first person, the person in blue, who says, I'm going to earn the money, not pay the tax, have the money earn interest, dividends, capital gains, not pay tax on that until I take it out. So what you can see, the person in blue is way ahead. Now let's say that they each work till they're 70. The person in blue has a lot more money, but to be fair, the person in blue hasn't paid taxes yet. So the person in blue pays taxes on the distribution, but because they have so much more, they can afford to pay the taxes and still have a lot more. So after a lifetime, you're talking about a $2 million difference. Remember, they earn the same, tax rates are the same, spending's the same, but by putting money in their retirement plan, even forgetting the match, there's a $2 million difference over a lifetime.